Good evening, everyone. Thanks very much for joining us. This is a program with built-in irony. The very people who might most benefit from watching it perhaps are the least likely to watch it. After all, when you're 20-something or 30-something, even 40-something, your retirement years are so far, far distant that there's plenty of time, more than enough, to prepare financially. Wrong. Unless you're blessed with the sort of famous last name that comes with a trust fund attached, time is of the essence. At least if you want a retirement that gives you what we all want, freedom. Freedom to travel, indulge a hobby, spoil the grandchildren, most of all, freedom from worry. Yes, there is a social safety net. No, it probably won't disappear. But will it enable you to live the balance of your life in the fashion you want? So our program indeed is for all age groups, and as our experts surely would agree, it would benefit even teenagers to watch. And if it is never too early to begin a lifetime financial plan, neither is it entirely too late. Now, an hour is hardly time sufficient to get across the basics of financial planning for retirement, or do more than that, but we can hit the major points, and that's what we hope to do tonight. And more, we hope to give you some solid advice on where to turn for a financial plan that works best for you. Our phone lines are open to take your calls. The number is 1-800-662-2386, or you can email a question at paffairs@aetn.org. And we'll remind you of that number and the email address during the course of the program, and periodically I think we're going to superimpose it as well so you can get in questions. We would urge you, as soon as a particular matter occurs to you or we touch on something that piques your interest particularly, we hope it all will, but go ahead and call in your question, and we will get to as many of them at the backside of the program as we can. We begin tonight with our first segment on taking the mystery out of retirement. And our guest is Dr. Craig Rennie, who's an associate professor of finance at the University of Arkansas. Doctor, thanks very much for being with us. It is mysterious. It sounds arcane. It sounds confusing, particularly to those of us who don't have degrees in finance, economics, and who some of us were even brought up to trust in good old CDs. The miracle of compound interest, it was called in those days.
Well, let me start off by just saying that you introduced the topic of retirement planning with the idea of freedom. I like the sound of that because really that's what planning for your retirement is all about. I like to think in terms of retirement financial planning in terms of 5 parts. The first one is setting up goals. People have to have goals, and that's going to include short-term, intermediate-term, and long-term goals. But the people typically that have goals are the people that are going to be most prepared either for retirement or really anything as it comes through life. But it's particularly true in the case of retirement planning. Secondly, you've got to have time horizons, that is specific target dates for things that you want to accomplish with those goals. Third, you need to create and understand your net worth statement and also your cash flow statements. I'm going to say a little bit more about those in a couple of minutes. Fourth, you've got to look at sources of cash for your retirement, how you can fund it. And fifth, how you can manage your cash through retirement, that is, watch your spending and that kind of thing. So let me talk a little bit first about goals.
Please.
With goals, you've got to have short-term, intermediate-term, and long-term goals. And by short-term, I'm talking typically anywhere from, say, 6 months to 2 years out. Intermediate, 3 to 5 years. Long-term, 10, 15, 20 years. And typically, retirement goals are going to be in the latter category. But you've got to have them all. And a goal is not a goal unless you've got it written down, and you've got to have dollar amounts associated with each of your goals. You have to basically build into those a time horizon, and the time horizon is going to be a date. So To me, a goal is both a combination of a dollar amount and a date. And remember, you're going to have those short-term, intermediate-term, and long-term goals. You've got to identify barriers, things that can get in your way to accomplishing those goals. You've got to review them periodically, and also your status with respect to your investments, what you're doing to accomplish those goals. And you also have to prioritize. Sometimes some goals are more pressing than others. Obviously, that's going to be something you're going to take into account. With respect to goals, people have financial goals for retirement. One of the most important that we believe is the idea of not outliving your money. Okay, people too often think that they have more in terms of sources for retirement, and their expenses will be less. So they're kind of getting sandwiched on both ends. And financial planning for retirement is something that really is a way to deal with that. You want to maintain your current or close to it, your current standard of living. You may have grandchild's education you're interested in supporting. You might have favorite charities or your church or whatever that you want to leave funds for. And you may even want to start a new business. Maybe there's an idea that you had that you want to take out into the marketplace. You also typically have personal goals for retirement, and those could include maybe you do want to work part-time in a career or second career that you find fulfilling. You may want to start your own business. You may like to travel. You may have hobbies that you want to pursue. You may wish to volunteer. You could even go back to school. Of course, I have a vested interest in that, being an educator. And let me talk briefly about the time horizon idea. Again, with time horizons, you've got to have specific dates that you're working towards. With retirement, typically they're going to be long-term goals, but there's also shorter ones. And again, you're going to probably want to prioritize those. The third area I talked about was your net worth statement and your cash flow statement. These are really key to understanding both where you are and where you're going to go. The net worth is kind of like a balance sheet for a company. So for an individual, net worth is simply assets minus liabilities. So some of your assets, for example, might be your house, certainly your retirement savings, that kind of thing. Your liabilities could include a mortgage, which hopefully will be paid off by the time you retire, but not necessarily. The cash flow statement is going to be where you have cash flows coming in and cash flows going out. And again, as you prepare for retirement, that's something you have to spend a fair amount of time working towards. If we look at the fourth area, which is retirement income sources, most people think about Social Security as an important source of funds. Of course, nowadays, if you talk to some of my younger students, they'll tell you that most certainly don't expect Social Security to be there the way it's promised, if at all. And Social Security, remember, was never really designed to be a replacement for retirement savings. It was kind of like a safety net. So you can't rely exclusively on Social Security. You want to have other sources, and those could include traditional pensions in some instances, certainly 401k plans. And some of the speakers tonight will be talking more about those.
SEPs IRAs.
Yes, Roth IRAs, traditional IRAs, 403b plans for people that work for nonprofits like the university. And those are all very important as a way of basically funding your retirement. And also, I want to talk briefly about investment vehicles. Most people use mutual funds, say within their 401k plans at work, and they may have them in accounts that are not registered, basically regular mutual fund accounts, but typically the mutual fund investments are in stocks, bonds, or could be cash securities like money market securities. And I have a slide up that you can actually pull that talks about the relative performance. This is a slide of one-year returns after inflation. There are annual returns. The first bar shows the returns on the upside and a downside case for stocks, and you'll see the upside case. In the best case, it's up 66%. That's for the period 1802 to 1997. Worst case, it was down 40. So you're taking a lot of risk relative, with stocks relative to bonds. If you go to the next slide, you'll see that the volatility of the stocks comes down. The orange bar, by the way, is bonds, and the green bar is cash. Think of that as treasury bills, relatively safe investments. So on a 5-year basis, say if you were investing for intermediate goals, probably you want to go with bonds, but definitely not stocks because of the risk. And then on the third slide, you'll see on a 20-year basis, the stocks continue to be the highest rate of return, but even in the worst case, they still generate close to 2%, whereas bonds and cash, you could actually lose money. So if you're looking at saving investments towards your long-term retirement goals, typically people are going to want to include at least some stock to make sure they don't outlive their retirement portfolio.
To a significant portion of our audience, one suspects the idea of risk sends a shiver up their spine. Really, no matter what your age. I mean, the whole idea of risk. How to determine what level of risk? There's risk in everything. Equities or bonds or fixed.
One of the key concepts in investments, of course, is the idea that there's a trade-off between risk and return. You get higher expected returns in exchange for taking higher risk. But one of the issues with being able to afford retirement is, in some respects, the greatest risk of all is to not take any risk. That is, if you invest strictly in treasury bills, you're not going to have any volatility in your portfolio, or very little, but you're also going to be eaten alive by inflation. So these are things that people have to take into account.
All right, and we're going to return in just a moment with more on that subject. First, closing the gap, investing and expense strategies for late starters. Owen McNulty, an investment executive with Raymond James Financial and Simmons Investor Services, in just a moment. They say it's never too late to stop smoking. That's what the doctors say anyway. Never too late to start investing, but very few of us know how to go about it. None of us, or very few of us, have the sophistication to weed through the enormous offerings and even the material that we get through the mail unsolicited, let alone those that we can find just walking into a bank lobby. How do we go about doing it?
That's a good question, Steve. One of the things that we always try to remind people is that it's never too late to get started. There are many reasons that people do get started late, whether it is they've put all their money into raising their kids, helping them pay for college.
Cash flow, just.
Cash flow, yeah. And, whether, with the recent recession in 2008, a lot of times people lost their job, made a bad investment. A lot of things we're seeing right now is actually people taking care of their parents, and that becomes a financial burden on them that stops them from saving. And one of the things that we try to do is help them close the income gap, because when they do get ready to retire, they're going to have many sources of income. And like we have on the next slide there, there's different ways with the income gap, how we want to close it. And many industry experts suggest that we're going to need at least 80% of our pre-retirement income to keep our current standard of living in retirement. Obviously, this is going to vary with every person, but when we sit down and we want to get a plan together for someone, we want to make sure that we do create enough income for them to live the standard of life that they want to.
So in other words, a predicate would be if, for example, at its simplest, somebody who makes $10,000 a year would need $8,000 annually.
Yes. And as we can see on retirement. As we can see on that slide, there's going to be different ways income is going to come in. Dr. Rennie talked about Social Security. That is going to be one way that they're going to have, that's going to be income they're going to have every month coming in. Used to when Social Security would send you a flyer up until a few years ago, tell you how much you're expected to get. Now you've got to go online and get it, but you at least know that's coming in. The second thing is going to be qualified retirement benefits. This is going to be pension income for people who have pension plans. Now, over the last 20 and 30 years, we've seen pension plans start to go away, and not as many people have them. And so what that's going to do is increase that retirement gap that they're going to have to fund. Now, how do we do that? There are several different ways how we do fund that retirement gap. One of the things we try to do is tell people not to stop, no matter how old you are, no matter how far you think you are behind. And if you took, if you had $40,000 and you put it in an investment earning 5%, in 10 years you're going to have about $65,000. If you added just $100 a month with that, you're going to have over $70,000. If you do over $200 a month, you're going to have over about $97,000 a year. And that all comes because of compound interest. Albert Einstein said compound interest is the most powerful force in the universe. And if we pull up the next slide there, we'll look at the rule of 72. And it's very important because if you want to know how soon it's going to take your money to double, what you do is you take the rate of return you're going to get and divide it into 72. As we can see on the slide, if you're getting 6%, your money is going to double every 12 years. If you're going to get 8%, then it's going to double every 9 years. And this is important because, we're going to live a long time. We plan on living a long time past our retirement. No one knows when we're going to go. And so we want to have, what I like to say is we want to have more dollars than days out there. And so, it's important to know because also, as you talked about inflation, if the cost of living's going up at 3% a year, you divide that into 72, your cost of living is going to double in 24 years. So if you retire at 60, by the time you're 84, the cost of living is probably doubled.
Mm-hmm.
The next thing I wanted to talk about a little bit is about how to tap your assets once you do get into retirement. There's several ways. A lot of people think that when you retire, you're going to roll over your 401k, do whatever, and it's going to get there and you're going to draw off of it. The problem is, you want to make it last as long as you do. And so we want to find investments that generate income for them. A lot of people don't think of the stock market as a place to get income from. But when you buy companies that pay dividends, that's a good way for them to get income, and in some cases rising incomes. Whether it be individual stocks, whether it be mutual funds that have equities in them that pay dividends, or individual bonds that pay interest. It's a way to generate income for them through retirement. Also, when we're looking at how to tap the assets out of the account, you need to look at the tax implications, whether it be a taxable account, tax-deferred account, or like a Roth IRA where it could be tax-free account. Obviously, everyone's going to be different. Their situations are going to be different. So you need to sit down and figure out what are going to be the tax implications once you do take them out.
Right.
A couple of things that people can do once you do retire. There are a couple of ways you can generate income. Whether it is just go to part-time. That may get you some benefits as well and produce a little bit more income. If there's a hobby you really enjoy, maybe make it an income-producing hobby. Become a consultant, do work like that. Kind of be creative and have fun with it, because if you're planning on retiring, you want to enjoy it. I think you mentioned the freedom to do what you want earlier, and I think that is one way to have fun with what you want to do and create that freedom.
Should someone in their 50s right now, say 50, 55, 60, what if they're saying to themselves right now, alas, too late? What would you tell them?
It's never too late, because you're going to have to retire. You're going to have to do something to create that income. It may not be the income that they want. They may have to work longer than they want to. But one of the biggest things that I come across is people who have started late, and they come and say, I'm behind. Should I be more aggressive and try to catch up faster? What they have to remember is, more risk does equal more return, but that door swings both ways. It also means, you can have more loss as well. And so that's when we sit down and create a plan. They have to be comfortable with what they own.
Right. And from that point forward, discipline's involved as well.
It's very important. The market's going to go up and down. It's inherently nonlinear. And so you're always going to have that volatility. That's not going to go away. But when we are buying, you have to remember why you're buying those investments. If it's a mutual fund or a stock that's producing income, you're buying it for the income, not the ups and downs.
Right.
couple other things you can do to help save once you get into that retirement mode is maybe downsize. Maybe you don't need that large house that you raised your kids in anymore. Maybe move to a smaller house or even a condo if you don't want to do the yard upkeep and all that good stuff. And so there's different strategies involved with, it's how much you want to spend. Then you're going to have to save that amount and, like we talked about earlier, close that income gap.
Yeah, right. Once again, we would delight in taking your questions, which we'll address at the tail end of the broadcast. The phone number, 1-800-662-2386, operator standing by. And email questions as well at paffairs@aetn.org. Investing wisely to avoid the financial risk of longer life expectancy. Glenn Atkins, coming up. Financial advisor and fixed income manager, portfolio manager with Garrison Financial, in a moment. Glenn talked just a moment ago and throughout the program about risk and the element of risk in any kind of financial investment. You look at two other big risks.
One of the things that we try to educate investors on, Steve, related to retirement, is the risk of outliving your money, and then inflation. We like to educate clients that there's two kinds of risk that relate to financial markets and investing. One is the risk of being in the market, like we've all experienced in the last 10 or 15 years, and even back to the Great Depression and the market crash in the 20s. So there's risk of being in the market, which is very real. But the other risk, the other side of that coin, is the risk of running out of money before you die. And like it or not, investors are going to be put into a situation of taking market risk and trying to embrace it, or on the backside, taking the risk of running out of money before they die. So it's important to not be too risky, and it's important not to be too conservative. A lot of times as investors approach retirement, they tend to get more conservative, but they have to plan on living in retirement another 25 or 30 years of life expectancy, and it's difficult to plan for that. The other thing that hugely affects the success of retirement is this notion of inflation. And inflation is nothing more than the rise in cost of living year in and year out as you go through time. And that can have a huge impact on investors and their success in the 20 to 30 years of their retirement. The other key thing is for investors to set the right withdrawal rate. In other words, what percentage of their investment portfolio can they safely withdraw every year in retirement and live off of? Historically,
without outliving their
outliving their investments. Exactly. Historically, investors, professionals would say perhaps you could take out 5 to 6% of your investment portfolio. If stocks return 10% annually, and you're taking out 5 or 6, and you're getting hit with inflation of 3, you're barely maintaining your standard of living. But with the kinds of markets that we've been in the last 10 to 20 years, a more appropriate withdrawal rate may be something in the 4% range, because the markets haven't performed as well in the last 15 or 20 years than they have historically.
Right.
So I think the current thinking is to perhaps lower that withdrawal rate to something in the 4% range. We've got a slide
on the basis of better safe than sorry, or just be conservative about
better safe than sorry, and you again getting back to the point of not running out of money before you die. Right. We've got a slide here, I think, that shows some life expectancies if an investor were to retire at age 65. The takeaway from this slide, Steve, is that even at retirement of 65, investors have to plan to live another 25 or 30 years, and many of them do. We've got another slide here that is really, to me, the key of this whole notion of not outliving your money, not outliving your money. Even at an inflation rate of, let's say, 3% annually, the cost of living for a retiree at 3% inflation annually is going to double in about 22 to 23 years. So if a man and wife go to the grocery store today and it costs $100 and they're 65, 20, 25 years from now, that same trip to the grocery store is going to cost them $200. And they've got to plan for that, and they've got to make sure that they have the right mix between stocks and bonds to earn that return, to not outlive their money.
Hard to imagine, but there they are. Those are the numbers.
They are indeed. They are indeed. And, somewhere between taking too much risk and putting the money under the mattress is a mix between stocks and bonds that investors can be comfortable with, sleep at night, and, meet their goals.
And I think it was Dr. Rennie earlier on the program who said there is the risk of not being in the market. That may be the greatest risk.
There's a lot of risk to that. If you look at market performance back since the 1920s, which includes the Great Depression, a world war, several regional conflicts, the oil shock of the 70s, all those events that we've had, the tech crash and the financial crisis of 2008, if you missed something on the order of the best 42 or 44 months since the 1920s, you might as well have had your investments in cash or CDs. So it's important to be in the market and embrace the risk of the market that we talked about, or you're going to be forced to embrace the risk of running out of money before you die. So we would counsel investors and retirees to take that market risk and understand it and use a professional to manage through it, rather than wake up 20 years down the road, 25 years down the road, and be completely out of money.
Is it possible for those who may be on the cusp of retirement already, or certainly within sight, to find a comfort level and still get a return?
It is
if they have never been in equities before or in the market before, if they've been strictly CD people.
It is possible, and the key to it is don't take more risk than you need to meet whatever your goals are, and diversify the portfolio, whether that's through 4 or 5 mutual funds or 20 or 30 stocks, 40 stocks perhaps, or the same thing in bonds. Mm-hmm. So in other words, don't put all your eggs in one basket.
Right.
If an investor's in 4 stocks and 2 of them are down 50%, nobody wins. But if they're in a very diversified pool, like a mutual fund, for example, those kinds of movements in individual stocks tend to work themselves out over time.
Protecting your investments. Best defense is a very wise and safe investor. And we're going to be talking about that in just a moment with Commissioner Heath Absher of the Arkansas Securities Department. Stay tuned. And before we go to the Commissioner, a reminder that your phone calls are eagerly anticipated with your questions for our panel of experts. 1-800-662-2386. Email questions welcomed at paffairs@aetn.org. Commissioner, thanks very much for being part of the program.
Thank you.
What do we need to know up top?
Well, I was going to start out by talking about some investment retirement planning mistakes. Actually, Glenn covered a number of these. One I did want to add was understanding liquidity needs. It's very important for senior citizens to understand on the front end how much it's going to cost them to get out of an investment, but also whether or not a market for that investment is active. And nothing is going to be more unfortunate if a senior citizen encounters a need for immediate funds and learns that they're either paying a substantial withdrawal penalty, like is often the case with variable annuities, or if there's not actually a market out there for the security that they need to liquidate, which is sometimes the case in things like non-traded real estate investment trusts or business development companies. So,
stock in a video rental company, for
exactly.
example, right?
So I think it's very important for senior citizens to understand one more aspect before they consider an investment, which is, am I going to be able to sell it? How much is it going to cost me to sell it if an unexpected event occurs?
So, in terms of an asset that we have, there's a lot of calculation that goes into it, or should go into it, even at the point of purchase.
Oh,
time
absolutely.
of purchase.
Absolutely. I think that the best advice that I can give senior investors is that go to a professional to really have a portfolio that suits you and is designed to give you the retirement that we've been talking about this entire evening, which is one that is based upon a reasonable budget, taking a look at your monthly living expenses, your health, your age, life expectancy, lifestyle, future plans, whether you want to leave things to your kids. All of those things need to be considered when determining what becomes a part of your investment portfolio. And another thing senior citizens need to remember, if someone is trying to sell you an investment and he's not doing it on the basis of that information, he's just selling you a product, which is what happens at the free lunch seminars or the free dinner seminars. They stand in front of a room of senior citizens and they say, this product is good for everyone. How do they know that? That tells me that they have absolutely no idea what their obligation toward that senior citizen is, because if they did, they would be making a specialized investment recommendation to those people. So seniors need to be very wary of those free lunch, the free dinner and free lunch seminars. And I tell senior citizens all the time, look, if you just can't avoid the free lunch, go. But stick your fingers in your ears and just don't listen to anything, and certainly don't buy anything. There's a number of signs of financial fraud that I think senior citizens can be on the lookout for. The first one is promises of high return but no risk. Typically, low risk investments offer a low return. High risk investments offer the potential, not the guarantee, for a high return. It never works the other way. That's like trying to get to Memphis without going through Forest City. You can't do it. I mean, that doesn't exist, but people still want to buy that dream. They want to buy that lie. So if someone offers you a high risk or a high return, no risk, or a guaranteed investment, that's a red sign. That's a red flag.
Yeah, you as commissioner know as well or better than anyone, there's a lot of trash out there. And there are a lot of people who might not necessarily have the investor's best interest uppermost in their mind.
That's absolutely
who to
right.
go to? I mean, who to find? Who to trust?
As a regulator, I want good broker dealers and good investment advisors in the market. I would not advise anyone to invest without the help of a professional. That's kind of like encouraging people to work on their own teeth without a dentist. You wouldn't do it. I mean, you want the professional there for that to happen. And so I tell potential investors, invest with someone you trust, but make him earn that trust. And the way to make him earn that trust is to ask a lot of questions and be very cognizant of how he's attempting to sell to you. If he's selling in a very high pressure manner, preying on your fears, I think that's a sign to get away. I tell senior investors all the time, a very common, very easy tool they need to utilize to take care of themselves is to tell this person that's trying to sell them something, I never make an investment decision without first talking to my blank. And that blank can be son, daughter, accountant, lawyer, niece, nephew, whatever. Legitimate salespersons that are selling a legitimate product want you to take the time to make an informed investment decision. So if they try to pressure you into making a purchase then by saying things like time is limited,
now or never,
now or never, hey, this deal is for today. If you do it today, I'll cut half my commission. There's no legitimate investment out there that's going to run out before tomorrow. And if a salesperson tries to force you into a sale at that time without talking to someone, with some kind of argument that it's limited or space is limited, I mean, that's a big red flag to get out, to avoid that situation. So you certainly don't want to have anyone that that's going to sell in that way. And another problem we see is called affinity fraud. And affinity fraud is where a person of a particular identifiable group uses his status or his role in that group to sell to other members in the group. Now, we see this a lot with church congregations, but also with military groups and ethnic groups, where they use the fraudster will use his status as part of this identifiable group to get over the biggest hurdle to selling, which is trust. And if I can get you to trust me, I can get you to sell.
Identity investing.
That's right. And the other problem is, if you feel like I'm part of the group and I've duped you, you're less likely to turn me in. And we see that all of the time. But the high-pressure sales tactics and preying on fears. Legitimate salespersons aren't going to try to sell an investment to a senior investor by scaring them into purchasing. Whether it's preying on their fears of getting older, or what the market has done or won't done, and things like that. A legitimate salesperson is going to sell to you, and he's going to want you to be an informed investor. He's going to want you to know everything about the investment and everything you need to know to make an informed investment decision. And so if he's not allowing you to do that, if he's putting pressure on you, that's a pretty big red flag that you need to get away. So those are the types of investment professionals you don't want to work with. But that doesn't mean you need to do it on your own, because I'm here to say most average citizens are not equipped to make informed investment decisions about what their retirement portfolio should look like. And that's why we rely on the professionals. But make them earn their money. If you have questions about what's in the account statement, call them, get the answers. Keep them on the phone till they satisfy your questions.
Yeah. We're going to take a quick break, as in measured in seconds, bring back our other panelists, and carry forth. Stay with us. And we're back with all four members of our panel. And Commissioner, I'd like to go back to you if I can, and then just go down the line. And this isn't with the specifics of investing, but it does go to the level of trust that I think so many, regardless of age. We're doing this broadcast, and hours earlier today came word of a potential 13 or larger $13 billion fine or settlement with one of the most respected or one of the largest investment banking firms in the country. We're coming through a 5 or 6 or 8 year period now where one of the most venerable houses in the history of American capitalism went under, and a couple of others were saved only by massive government intervention. People are spooked. They're angry. And how does that play out across? Does that make investing harder? Are people more reluctant to get in there?
It absolutely does, I think, and that's what we're seeing with senior investors right now. They've seen the value of their retirement portfolios of stocks, mutual funds, and maybe T-bills, CDs drop. And they've seen the horror stories about what's going on with big board stocks and with the big investment banking firms, and so they're moving into all what are so-called alternative investments. And these are investments that historically been held by institutional investors. And certain aspects of these type of investments, alternative investments, make them the suitability for a retiree very questionable. They're typically very speculative and very illiquid. But it's the combination of the fear of the traditional securities markets based upon what's happened in the last couple of years.
Illiquid meaning tough to market.
Tough to market. Take example, a non-traded REIT. You own an interest in an entity that owns real estate. Well, there might not be, the entity might have a buyback program, but usually those are voluntary. So you're going to still get a return, but you can't get out. You might buy a privately placed security in a small company, and there's just no market for it. The same thing with BDCs, promissory notes, and all of those things. And we're seeing investors that historically haven't invested in those types of securities investing in them now because they're scared of the traditional market. They've seen what's happened to their 401k plan or their IRA. They've seen the values drop. And also the need for yield on a day-to-day basis to pay the living expenses.
Yeah, gentlemen, any thoughts on that?
One of the things that we try to do, Steve, is to educate our clients to the risk in the market and study the market historically and encourage them to do that and look at those ups and downs, but look at the growth over 10, 20, 30 years, which is typically their planning horizon. Historically, if they can weather the downturns, even the multi-year ones like we've had now, and in back in '74 during the oil shock, after that, the market has gone up exponentially since then. And I think it gets back to something, too, that the commissioner said earlier. This is a very personal business, and it's about trust, and it's about, do you believe in the strategy of the broker or the investment advisor that you're talking with, and do you have a good rapport with them, and do you have a good trust factor, because it's a very, very personal business.
Yeah, I agree with that. Also, one of the things that we try to do with our clients is you want them to own quality. It's like the commissioner was saying, if you buy that non-traded REIT, it's illiquid. That may not be quality. We want our clients to own quality names that they're familiar with, that have paid dividends for a long time, and that are going to continue to pay that dividends and keep giving them that income during retirement.
Yeah, on to some Dr. Rennie?
J.P. Morgan, that you were giving the example for this earlier too, with that $13 billion fine that they're negotiating. You have to remember that the market may have been expecting a substantially bigger fine, and it's related to Washington Mutual, which they kind of took over almost as a favor to the government at the time. So without commenting on the specifics of that, I would just suggest to you that something Glenn mentioned, the importance of diversifying your investments, say with a stock portfolio and also with bonds and other securities, but diversification is key. So even if a company gets into trouble and has to pay a $13 billion fine, if you're in a diversified portfolio, you're going to spread that risk among many other different companies.
Let me go into some specific viewer questions. A Craighead County viewer asked, would any of you just reflect on annuities as a vehicle for retirement?
I think that's a good question. It's
Pros, cons. Yeah.
Right. I mean, it's definitely going to depend on the person and their needs. There's all kinds of annuities out there. Some of them may be good, some of them may be bad. It's going to be what that person's needs are. We talked about earlier about coming up with a plan. Everybody's plan is different. There's not one specific plan. You can't say, you need this allocation, you need this in vehicle. There's not just one investment for one, for everybody.
It's like we mentioned earlier, for someone to give reasonable investment advice, they have to understand a lot about the client. As we mentioned, the client's age, risk tolerance, all of those things. The one thing about annuities that are a little bit different than some of the other investments we've talked about, that in Arkansas, an annuity is an insurance product. It's not a securities product. So clients do need to understand that the duties owed by the sellers of those products are much different. An insurance agent that's selling an annuity doesn't owe the duty to his clients that a broker-dealer owes, which is kind of quasi-fiduciary. I'm stretching a little bit, but and then with an investment advisor, it's an outright fiduciary duty. So there is a big difference, and typically what we see in the free lunch seminars are annuity sales, variable annuity sales. Now, I'm not saying that variable annuities are a bad investment. Certainly for some investors, I think they would make a perfectly good part of an overall portfolio. But to the issue I have, or the free lunch seminars, with the insurance agent who has no obligation to anyone there, stands up in the front of the room and says, every one of you needs to buy an annuity. Well, if he's making a recommendation to everyone based on knowing nothing about them, he's not trying to build a portfolio for these people. He's not trying to offer personalized investment advice. He's trying to move a product.
We don't do annuities in our practice, but one specific case where I've seen them work before is if you have an investor, say, that has inherited some money and they tend to be spendy, they tend to spend a lot of it. It might be appropriate to put them in an annuity that has a fixed cash flow over a long period of time.
Yeah, who do they fit?
Exactly, who do they fit? So if you've got an investor who tends to spend a lot of money and might run out of money before they die, it might be appropriate in that situation.
And here's a Garland County viewer who wants to know about municipals. Who are they good for or right for? We're talking about municipal bonds.
It's the same answer as the variable annuities case. Overall, fixed income investments, you're looking whether you've got a taxable or a tax-free issue. Most municipal bonds are going to have some sort of credit enhancement, whether it's a letter of credit behind it or a guarantee from a certain governmental entity. A lot of times these are conduit financing, so you have to look at what the underlying entity is actually using the money for. Now, again, I think that's the hardest thing to tell people when they ask these questions. Are municipals good? Well, it depends on you. It depends on where you are, what you want to do, how much you want to, the level of income. And like the things we talked about earlier, you don't want to be too aggressive, you don't want to be too conservative, and all of these things can fit in there somewhere.
Especially in the case of munis with people who are at a high marginal tax bracket, because those are the ones that are going to benefit best. But that's just one of the many factors that goes into this assessment that Mr. Absher is talking about with respect to identifying, the ideal mix of a portfolio. It's going to be client specific.
Right. A Carroll County viewer has been told, and seems rather irritated by that he is going to be compelled to start taking money from a very large annuity at 70.5, suggesting that perhaps he'd rather leave it there than take it. Is that accurate?
That is accurate. If it's an IRA annuity, it is. There's an IRS regulation that says that when the year someone turns 70.5, they have to start taking a required minimum distribution, or RMD, because that money inside the IRA has not been taxed before. It's pre-tax money. And so basically what the government's saying is we want to tax you on some of it before you die. So there is that is an IRS regulation that they want to get some of it,
Nice.
So, but yes, that is a regulation he has to, and the penalties not to do it are very stiff.
Yeah. So. T anyone? Okay. All right. From Washington County, verbatim. This individual is 59, has worked various or different places, and has retirement funds, accounts, whatever, it's not clear, in several places. Would it be best to consolidate those in an IRA if possible?
I think it would be best just from a matter of pure simplicity. If you consolidated them at one place, you would have everything on one consolidated statement, easier to view, easier to keep track of. The counter argument to that gets to one of the themes that we've talked about tonight, and that is diversification. So the flip argument to that would be have maybe one or two investment advisors or brokers, or three perhaps, depending on the size of the portfolio.
And the other thing to consider is when you have multiple retirement accounts held with multiple former employers, you're no longer there. You've lost the ability to weigh in on questions of changes to the plan and things like that. You're at the peril of your former employer. Certain changes can be made that may be in your best interest, may not be in your best interest.
Right. From down south in Miller, southwest in Miller. A question that a lot of people have, particularly when they turn 60, 61. At what age do I say yes, or should I say yes to Social Security?
That's going to go back to what the commissioner was saying earlier. Everybody's different. You know, everyone's income needs are going to be different. And so, you know, what I see when I talk to clients is you have some that say, you know, I want to get it because I want to get it before it goes away. You know, that's just some people thinking. You know, I'm not saying it's going away, but that's what they're thinking. The other thing to remember too is, though, the longer you wait to take it, the more income that they're going to have going down the road. But again, it's going to be, you know, client specific.
How are you feeling today?
Well, what their income needs are. You know, if they don't need it, then it may grow for them if you don't start taking it.
The hard part to that is, or the simple answer to it is, if you knew exactly when you were going to die, you would know exactly when to begin taking Social Security. Because as Owen said, you know, the longer you wait, the more you get. But you know, it literally depends on your date of death, what that decision is. So I think one of the best things that an investor could do is, when the time comes, look at their health, look at their plans, look at their diversification, all the things we've been talking about tonight, and make a decision then.
From Pulaski County, who has any, well, the question is, gold as an investment opportunity, I would change it. Who has any business messing around with gold? Commissioner?
Well, gold itself is actually not a security. It's a commodity, and unfortunately it doesn't fall under my jurisdiction. However, I do have an opinion.
Shoot.
Gold prices and literally a lot of foreign currency prices are subject to forces that drive the prices up and down that are not in any way similar to what we see in the equity markets, not even any way similar to what we see in the debt markets. I mean, there is typically, you assume, for example, in the foreign currency markets, in equity markets, you assume that there's transparency and there's no nefarious activity, anyone trying to affect stock prices. There's not a country out there that's not trying to affect its currency value. And gold's the same way. People assume that gold goes up when the stock market goes down. That's not really the case. Gold moves, precious metals move based upon attributes that are very much unique to those gold and precious metals, and typically it's pretty speculative. You have to have a specialized knowledge to invest in those. And I wouldn't touch them unless you really knew what you were doing.
I agree completely with that. In fact, we looked at this notion of gold as an investment several years ago. And if you go back to when the dollar went off of the gold standard under Bretton Woods, I believe it was the Nixon administration.
74, I believe.
74. From that time through present day, gold has not kept up with inflation as an investment. Now, if you look at it over the last 10 years or so, it absolutely has been a good investment. But from the time of 1974 off the gold standard through today, gold hasn't even kept up with inflation. So you're losing standard of living if you had been in gold since from 1974 to the present day. So it gets back to what the commissioner says. It's very speculative, and it's priced on things that don't have a lot of, they're not based largely on an intrinsic value. Yeah. They say gold is an intrinsic investment, but in fact, it's very illiquid. You can't eat it. It costs to store it, and it hasn't kept up with inflation historically.
Unsophisticated investors should not apply.
Yeah, at the risk of being maybe a slight contrarian here, my view is I agree that gold and other commodities are driven by other factors than factors that typically drive stock returns or what's happening with bond returns. But if you have a professional investor advisor that is using it as part of a highly diversified portfolio, the fact that the returns on gold are not highly correlated with other securities might add some value to a portfolio. But again, here you really need a professional, excellent advisor who's going to be able to take that into account.
We see this every time the market goes south. Inevitably, there's something that's offered. I call it newspaper fraud, but it's really not what it is. That When you read something in the newspaper, it adds legitimacy to a fraud scam built around that story, whether it's in response to that story, on the basis of that story. And I'm sure you guys have all seen the same thing. It's the push for everyone to invest in Iraqi dinars following the war in Iraq. You don't know how many people called up my office and said, "Yeah, I just bought, $3,000 worth of Iraqi dinars." What are you going to do with them? Where are you going to sell them? I mean, we don't even know if Iraq is going to have an economy in a couple of years. But people buy into that. The market south. I'm reading about this war in Iraq. Hey, when the war is over and their economy gets built back up, I'm buying low and I'll come out when it's high. That assumes the economy of every other country on the face of the earth stays stagnant at the same time.
Surprised we haven't gotten this one so far, and our time is limited. It's all over the airways. For reverse mortgages, good, bad, what?
Depends on what you want to do with it. The one thing I will say, that if someone encourages you to enter into a reverse mortgage in order to make an investment, don't do it. Because inevitably what they're doing is tapping your last line of cash to put into an investment. Reverse mortgages can be a useful financial planning tool for the right person with the right goals and the right plan. But to enter into a reverse mortgage to pull all the equity out of your home and then invest that equity, you've just kind of gambled with your last dollar.
Yeah, well, with your biggest assets.
That's right.
Anyway, gentlemen, thank you. We are simply out of time. We appreciate your expertise and your time and yours. See you next time.
This program is brought to you in part by a grant from the Arkansas Securities Department and the Investor Protection Trust.